made 17% CAGR in last 20 years. Now, only one thing which investor has to certainly do, invest the money and forget about it. But there is this problem that the investors do face the significant high volatility in the equity markets, and which is where they either get overexcited or become nervous, and which is where the investors potentially make mistake, and which is that's where I'm sure the number of investors or the distributors have asked if they have made full use of the decline or the fall that we have seen in 2021, in March of 2020, and most of them expressed disappointment that they have not been able to do it for various reasons. But that's the kind of opportunity if the investors have grabbed. Maybe the return which we have just spoke about, 17% CAGR and CAGR. This is the nominal GDP growth. But if you see the underlying volatility, it is one trending curve upwards, which is what it is there. There is hardly any volatility as far as or very significantly lower volatility as far as GDP growth is concerned. But when you look at the same in terms of what the markets have delivered during the same period, 17% CAGR, but here you see a significant big volatility in the underlying markets, which is what makes investors nervous, and this is what has not been explainable, because if you see underlying corporate earning growth, which is in line with GDP, maybe plus minus 1%, but when you see the volatility as far as equity market is concerned, it's more than 5x of what we have seen in GDP. If we were to supposed to follow the underlying fundamentals, then what explains this 5x volatility in the Nifty, which is, let's say, if the GDP volatility is 4.7% in last 20 years, the Nifty volatility is 31% plus, right, which is more than 5x. Now, we all know intuitively when things go well, we lower our guards and we want to start participating in the market, and which is where probably is the time when we make the mistakes, and probably many of us actually start to participate when the markets are at peak. Similarly, when things don't go as per our expectations, we certainly become risk averse, stop taking risk, and which is where probably the bottoms are created. And most of the case, you will find that when the bottoms are created because either the investors are selling or they have stopped investing. Probably at the time when the investor should have invested the money, he has, at the time when the investor should have taken out the money, probably he was putting the money, which is where the peaks are created, and the time when the investor should be investing actually is the time most of the investors have taken out the money. And this is quite visible when we look at how the mutual fund net inflows. So here what we're showing is that from 2008 to 2023, this is collective 15 years of data, net mutual fund inflow. And what here you will find is that when the PE is less than 20, collectively in last 15 years, when the PE is less than 20, we have got less than 16,000 crore of net inflow. Now, I'm sure you know this number, that the monthly SIP as far as mutual fund industry is concerned is more than 14,000 crore. This clearly demonstrates the kind of behavior which the investors have seen. Probably the time when they should have invested, they have missed that opportunity. And because they have missed that opportunity, whosoever is invested in that period, the next year the return was 28%. But look at the behavior of investor. When the PE in this last 15 years, when the PE is more than 20, what mutual fund industry has collected is more than 10,69,000 crore. Massive 10,69,000 crore, and it's in multiple of what we have collected when the PE is less than 20. Clearly, what investor is doing, investor is looking at the past return and then investing. And what he or she is getting is just next year, because he has chosen to invest in this fashion, he or she has just got 6.6% return next year. Clearly, this mutual fund net inflow is telling you that probably the time when investors should be urging or maybe becoming more greedy is the time when the investor is actually choosing not to invest, and probably when he should be fearful is the time when the investor is actually investing. So this is also clear from the study which has been done by Morningstar. Now, I need not introduce you Morningstar here. It is globally renowned agency. What they have seen, and this is done for Indian mutual fund industry. This is a period of this is where they have done the study in November 22. What they have seen is if the scheme has generated 12.33% return in last 10 years, what investors have actually realized is 9.53%. Purely because what we have been discussing, this big volatility in equity market makes investor either greedy or fearful, and because they have this habit of checking their NAV either on a daily or a weekly or a quarterly basis, is what is causing them to act consistently, and which is what is causing them this loss. If I were to put this number in a different fashion, 10-year back, if the investor has invested 1 crore rupees and completely forgot about this and has remained inactive, probably the value of that investment would be 3.2 crore rupees. But because investor chooses to check his or her NAV on a daily, weekly or a quarterly basis, and if you have forgotten that, maybe the tax department reminds you because you have to file your returns once in a year. Because of that, probably investor acts, and because he or she acts, what he has realized is just 2.49 crore rupees, which is good loss of 71 lakh, potential loss of 71 lakh rupees. Remember, this is on an investment of 1 crore rupees, a potential loss of 71 lakh rupees. Now, this is the reason why we've been saying that not all investors actually are behaving the way they should be behaving, and this is where many of the investors need to realize that not everyone can withstand this big volatility in the equity market. There is this expectation of a reasonable return, but with significantly lower volatility, which is where the asset allocation actually comes into the play for investors. And when you look at compare the return of fixed income versus the equity, certainly the return of fixed income is much less than the equity return, but the volatility, underlying volatility in the fixed income is low as well. And which is where if you combine these two assets, because inherently these two assets have low correlationship, if you combine these two assets, you can generate potentially a reasonable return with significant low volatility. Probably this can be done with a fixed asset allocation, which is either 50-50 fixed equity or fixed income, or a 90-10 or a 30-70 kind of combination. But there is a possibility of doing dynamic asset allocation as well. And if you choose to do a dynamic asset allocation yourself, maybe you can generate a relatively high return, a reasonable high return. Potentially you can generate that, but with significantly lower volatility. But there are multiple challenges. Can you do it yourself? This dynamic asset allocation, which generates or which potentially generates a reasonable return for you, there is this challenge. The biggest challenge is to manage these emotions of greed and fear, because we clearly know that, and even in the two slides that we have seen, investors have consistently demonstrated that probably not all of them have managed this emotions, how to control the emotions, and which is where this is the biggest challenge. Even if the investor has managed it for once, then the other challenge is how do you figure out whether the markets are expensive or cheap. Even if you do that, which securities to invest, and the biggest challenge the investor will also, other challenges they will face, is how to do it in a tax efficient way, in a lesser cost efficient way. Even all of this, if you can figure out once, how do you ensure that you consistently do it? So dynamic asset allocation between equity and fixed income has this potential to generate reasonable return, uh, but the challenge is investors will most of the case find it difficult, which is where for investor there is a need of a professionally managed dynamic asset allocation scheme, but most importantly here they need a disciplined approach of managing the greed and fear, and which is where UTI Balance Advantage Fund comes into the picture. In UTI Balance Advantage Fund, we will have diversification, dynamic approach, and disciplined approach. Diversification between equity and fixed income. We will be doing a dynamic asset rebalancing between equity and fixed income, but most important, a disciplined approach, which will be guided by model. Remember, the biggest challenge which investor face is discipline of managing emotion, greed, and fear. In our case, it will be guided by the model. Even the fund manager will not have the say. What the fund manager will do, what the model says as far as asset allocation is concerned. Like we've discussed, here for us, the net equity allocation at any net equity allocation will be ranging between 30% to 90%. However, gross allocation at any point in time will be higher than 65%, so that the scheme avails equity taxation benefit. And once we decide what is the net equity allocation, the balance proportion will go towards fixed income, and here fixed income is actually providing stability to the portfolio. So like I said, what is the most important feature again is the discipline of valuation and discipline of taking the net asset allocation as guided by the model. So the other important question is what goes into the model. So there are four factors. These are four fundamental factors which make intuitive sense to Sachin Trivedi. It makes intuitive sense to you and probably to your investors as well. What are these four ratios? The first is price to earning, 1 year forward price to earning. Second is price to book. Now we all know that these ratios, higher the ratios basically means that markets are more expensive and therefore you should be taking your allocation lower. The third ratio which comes into the picture is the dividend yield. Now we know dividend yield tells you the health of the company and therefore the markets as well, and higher the dividend yield, higher should be allocation. The fourth factor, and probably it's the unique factor in our model, is the yield gap. What is this yield gap? Yield gap is telling you at a point in time what is the alternate investment option, which attractiveness of one option over the other option. Basically, whether the equity is more attractive or the fixed income is more attractive. And combination of these four factors. So first three factors are basically telling you the health of the market. The fourth factor is telling you attractiveness of one asset over the other asset. Combination of these four assets go into the model to decide what should be the net equity allocation for us. And again, like I said, dividend yield, higher the dividend yield, higher the allocation. Similarly, higher the yield gap, higher should be the allocation. So in this slide, what you will see is the shaded area is telling you what was the market starting of 23, what was the market level at various point in time, and the line graph is actually telling you what was the model indicated net equity allocation at various point in time. Like you see here that in February of 2020, when the markets have touched 12,081 level, our allocation was close to 54.5%. But as the markets have collapsed in March of 2020, our allocation has went up to as high as 86.6% when the market has touched the bottom of close to 9,267 level. So and as gradually post that, markets kept going up in the valuation, not just in the levels but in the valuation. In May of 22, we have actually touched the levels of 43%. So what we trying to show here is that the model is reacting not just to the market levels, but more importantly, our model is guiding us based on what are the underlying fundamental valuations are. Here, our approach is valuation driven rather than just the market levels, which is what you will see in the next slide. It's when the PE ratio back in March of 2020 has collapsed to maybe close to all-time high in the entire decade. Our allocation went up to 86.6%. Similarly, in December, between September to December, when the markets of 21, when the markets valuation became expensive, our allocation has gone as low as 43%. Same is true with price to book ratio, and similarly, post the market correction, dividend yield went up significantly. Our allocations have also gone up. And here, like I have said, yield gap, which is one of the unique factor, what it is demonstrating is attractiveness of one asset over the other asset. When the markets have collapsed back in 2020, March of 2020, yield gaps have gone into the positive territory, which is one of the rare thing in the entire decade, which is when our allocation has gone as high as 86.6%. Similarly, when the yield gap has gone below long-term average and closer to negative of 2%, again our allocation went as low as 43% as well. So, like I said, our approach is completely valuation-driven approach. 4 fundamental ratios go into the model to decide what should be the net allocation. Now, in this slide, what we are showing is calendar year-wise what is the Nifty TRI outcome and what is the UTI BAF model outcome calendar year-wise. What you see here is that on a summation in entire 11.5-year period starting January 2012 to June 23, if the Nifty TRI has generated 14.6% return, UTI BAF model has generated 13.7% return. Now, I must urge you caution, this is gross of fee, and input here is passive input of Nifty 50 and respective debt index. But remember, here what you see is the outcome of Nifty TRI of 14.6 versus BAF model of 13.7. But like I said, this is for the investors who have realized that they cannot withstand this high volatility of equity market, but they need a reasonable return, but with less volatility. And which is what you will see here. The standard deviation, if the standard deviation of Nifty TRI in this 11.5-year period is 15.9%, UTI BAF model is just at around 10.8%. So we have done, we've got the return in the BAF model of 13.7, but with lesser volatility compared to Nifty. Now, this is an outcome of the portfolio with respect to its benchmark. Benchmark here is not Nifty TRI, but benchmark here is Nifty 50 hybrid composite debt 50/50 index. Now, here we have given alpha calendar year-wise for entire 11.5-year period. But to sum it up, if the benchmark has generated 11.6% return in last 11.5 year, what UTI BAF model has achieved is 13.7% return, which is an alpha of 2.1%. Yes, standard deviation is slightly higher than the benchmark, but like you have seen in the previous slide, the standard deviation is significantly lower compared to the Nifty TRI. Therefore, what we are trying to generate here is a potentially reasonable return for investors, but with significantly lesser volatility as well. These are the capture ratios which you as a distributor may be interested in. Upside capture ratio of 67% in this 11.5-year period, and downside capture ratio is 49%. And these slides are basically telling you in this entire 11.5-year period, in the quarter ending, when the Nifty has given negative return, you will see that almost all the period we have outperformed the benchmark or outperformed Nifty TRI. In the period when Nifty has given between 0 to 8%, we have, except one instance, we have outperformed in all the cases. Yes, when Nifty has given between 8 to 15%, we have, except few instances, we have outperformed. And finally, but in the case where Nifty, in the quarter Nifty gave return higher than than 15%, we certainly underperform. But combination of these four slides will give you a reasonable return, which is an alpha of 2.1% over the benchmark, but with lesser volatility. So this 2.1% alpha generation was from asset allocation, but there are two sources of alpha generation as well, which is sector selection and stock selection. And fixed income, like I said, which is the balancing part, will give you basically stability as far as this portfolio is concerned. When we talk about portfolio style or what will be the strategy of this fund, like I said, gross exposure at any point in time minimum 65%, but net allocation will be between 30 to 90%. Style of management here will be a blend style, because you know that the growth and the value styles come with their own outcomes, but with a higher risk as well. For me, the investor is investor looking for reasonable return and conservative investor, which is where the blend style mix, and therefore we will look for the stock both from the value and the growth style as well. But end of the day, what we will deliver is a blend style. Like this is a dynamic asset allocation portfolio, which is where it's a large cap bias portfolio, and we will take sectoral calls as well to generate alpha in this fund. As far as fixed income is concerned, like I said, this is the part of the portfolio which is providing stability to the fund, and which is where credit is not the source of alpha generation. And here we will invest in GSET or very good quality AAA or equivalent good rated state papers, depending on the spread available at that point in time. The fund manager was Anurag Mittal, who's deputy head of fixed income. So from duration perspective, here we will take duration call depending on the outlook on the interest rate, but maybe between 2 to 5 years kind of a duration max, but largely remaining in the moderate zone. Just to sum it up, we have seen two slides where it is quite evident. In India, investors find it difficult to control their emotions, which is where this scheme return versus actual return comes into the play, where investors loses out potential return. It's very difficult for them to control emotions, and which is where there is a need of dynamic asset allocation from investors' perspective. But when we talk about dynamic asset allocation, here the discipline is the most important factor, which is where UTI Balance Advantage Fund, through model guided approach, will bring in that discipline of dynamic asset allocation between equity and fixed income in tax efficient way. Therefore, in net it will try to generate potentially a reasonable return, but with lesser volatility. With this, I'll just stop here and hand it over.
My question is, how does it different from other balance advantage fund available in this space or the industry?
Yeah, like I said, whatever the outcome backtesting outcomes that we have shown, but like I said, from our perspective, basically we will be guided by fundamental ratios, which are 1 year price to book, which are 1 year price to earning, forward price to earning, price to book, dividend yield, and yield gap. So these are four fundamental ratios, and maybe like I said, yield gap is one of the unique factor. But from our perspective, these four valuation based approach will go into deciding net allocation, and once the model decides that what should be the net allocation, there is no discretion available to the fund manager, and we will be guided by that approach. Because remember, the biggest problem is this managing emotions, which can be an emotion of an investor or a fund manager as well, which is where the model is guiding us what should be the allocation, and this is purely fundamental approach from our side. Like I said, the model gives us the input every week, and once the gap between the portfolio and the model guided allocation is higher than 7%, is the time when we actually go and affect the change without putting any biases here, and that's how we are different compared to rest of the models. And the second factor is, like I said, the net allocation for us will be between 30% to 90%. That's how maybe these are the two unique factors from our perspective. So how frequently you will do the rebalancing between applying these all four factors in the portfolio? Yes. So, like you can see in this slide as well, what we have seen in this entire 11.5 year period, there is a rebalancing on an average in once in 3.5 months. What that means is that there is a period of maybe 6 or 7 months when there is no rebalancing at all. But same time, if you see between March or February of 2020 to April of 2020, we have taken close to 3 rebalancing in a period of just 1.5 months. So, which is like I said, model gives me signal every week, and if the gap between portfolio and model is more than 7%, we will go and execute the trade. But on an average, it's basically one rebalancing in 3.5 months. But like I said, 6 months no rebalancing, but market actually goes up or down. Accordingly, we will do the rebalancing as well. So purely valuation driven approach from our side. Yeah, thank you.
Yeah, what would be the percentage of allocation into mid and large, mid and small?
Yes, good question. So, like I said, this is dynamic asset allocation. So for us, this fund will have a large cap bias. If you ask me, what is the possible or what is the model portfolio at this point in time? What is the allocation towards large cap? Maybe this is higher than 85% today. But yeah, because of the nature of the dynamic rebalancing, it will be a large cap bias, probably between 75 to 80%, below which it won't make sense for us to go below that level. But yes, like I said, today a model portfolio will have a bias of close to 85% plus on large cap side. Small cap will be a very smaller proportion, maybe less than 5%, and the balance will be towards mid cap.
Thanks.
Yeah.
I just wanted to understand the weightages assigned to each of those four factors which are driving the output of the model.
Yeah, so like I said, these are the four factors which go into the model, but because we run a detailed statistical analysis before we come out with the next year expected return or the allocation from our perspective, these are the ratios which basically based on the input goes into the model each day. These proportions keep changing. And which is where it may be incorrect for me to give you one number today, because when I run the same thing tomorrow, maybe the proportion assigned to each of the factor may change. Therefore, it is it may be right to say that these are the ratios or the proportions assigned to each of the factors are variable and keeps changing every day with the fresher inputs which go into the model. But certainly this is not a fixed kind of a 25% or maybe a 20-30% kind of a ratio. It keeps changing every day, like I said, based on the input goes into the model.
You showed us a slide wherein the BAF has outperformed the composite hybrid by around 2%. Do we have any figures in terms of what was the average allocation towards equity during each of those groups?
So average allocation towards equity in this entire period is close to 62% plus.
So basically, we generally suggest many of the senior citizens to park their money, hard-earned money, and into this balanced advantage fund category. And I would wanted to understand from you, like we suggest SWPs also for this people who wanted regular income, like a passive income. So would you suggest SWP when and where and what percentage and what time would be the ideal time to start SWP in this fund?
So maybe my marketing team will be in a right position to suggest based on the client's profile, and maybe they can touch base with you. But what I will say is that anyone who has a lump sum money, obviously people can do SWP, people can do lump sum, people can do SIP as well. All the three routes are fine. But the essential message from my side is if you have surplus money, be it already invested or if it is sitting in your bank account, you outsource your worry about what should be the asset allocation between equity and fixed income to a fund manager like me, who is taking this net equity allocation decision based on fundamental ratios, based on valuation, rather than based on whether the markets are all-time high or they have gone low, significantly to 30%. What I'm saying is that if you have money sitting in your either your investment or your bank account, you outsource your worry of asset allocation to fund manager like me, or to UTI Balance Advantage Fund, where we will take this asset allocation and try to generate reasonable return for investors. But yeah, for finer detail, maybe our marketing team can or our sales team can actually approach you.
Some of my questions already got answered. So one question of how much a fund manager take a deviation from the model. So is there any specific limit you have, plus or minus?
Oh, so from our perspective, like I said, let's say the model, my portfolio is sitting at 67%, and next week my model says your allocation should be 75%. The difference between my portfolio and the model is more than 7%. Is the time when fund manager will go execute, like I said. Once the based on the formula, if it is signaling there should be a change in the portfolio, maybe a maximum deviation of 3 or 4 days to execute the trade, but we don't intend to exercise our discretion. So let's say in this case the model has said 75%. Once it is triggered in the weekend, maybe it will take 3-4 days to execute, but we will try and confirm with the model straight away. So no discretion as far as FMs are concerned.
Okay, thank you. And one more thing, like most of these ratios or maybe see anything related, like future related decisions. This model will basically indicate after market mode or after the corporate results. So basically these two incidents will affect the ratios basically, and or like the yield ratio, what you are talking about. So any futuristic call we will be taking, so based on the expectation, say next quarter or next year ka expectation of corporate results. Based on that, you will take any call, or it's all based on the already happened results.
So, like you see, the first ratio itself. So, in first ratio itself is 1 year forward price to earning ratio. So, when we take 1 year forward price to earning ratio of a Nifty, there the analysts are already trying to predict what's going to be the next year earning, and these are normalized earning from their perspective, and which is where what you're trying to ask, that how the earnings will shape up in next year is what is being taken into account when we take this ratio. But the balance number, which is the price to book ratio, dividend yield, these are trailing numbers. Probably the yield gap also partly take into account the 1 year price to earning and minus the 10-year G-Sec. So yeah, just to answer, 1 year price to earning ratio for 1 year forward price to earning ratio takes into account what you're trying to ask.
Yeah, thank you.
Yeah, thank you.
What was the maximum drawdowns happened in the last from the calendar year 12 to till 23, and the recovery period the fund has taken?
So we can get back to with that. So let's say if you see this slide, which is when I think in March of 2020, in a quarter when the Nifty has declined by 24%. This is just the quarter ending March of 2020. When the Nifty has declined by 24%, fund was down by 14%. I hope it is giving you the answer that you're looking for. because this captures this entire 11.5 year of period when we have backtested all the quarters. Probably March 20 was the worst quarter, and in this worst quarter, if the Nifty has declined by 24%, fund was down by 14%. But this is the quarter end, and summation of this is what you see the overall picture: upside capture ratio of 2.8%, downside capture ratio of 49%.
Okay, thank you.
Sir, one more question. That why BAF now? Because market is almost all-time high now, and most of the AMCs are actually bringing up with the new NFOs. And although balance advantage is a kind of category which we actually sell heavily to all our clients. But why BAF at this point in time when the market is almost all-time high now?
So when I ask this question, what do we do? The first slide that you've seen, markets at all-time high, and I ask the question to most of the partners like you or the investors. The common question is quite confused. Common answer is quite confusing. Whether some of them say that market is all-time high, I should redeem. Some say I should be investing. Some say I should be doing SWP. But none of them say the valuation-based approach. So when the markets are hitting all-time high, many of the investors are actually worried about what do they do with their money, whether they should take out some money or not. Which is where we have this fantastic product, which is trying to say that you outsource your worry to us. Based on valuation, we will take this call whether your allocation should be 90%, 60%, or 30%. Which is where it is a apt product at this point in time for the investors.
I would like to ask about the fixed income. How do you plan for a fixed income strategy? Whether you look at the GSEC yield or you look at the interest rate scenario, or how do you allocate with the fixed income asset class?
So once we decide that net equity allocation, the balance portion will go towards fixed income. But as far as fixed income portfolio is concerned, here our strategy is clear. It should be high quality paper with complete liquidity, which is where we will invest in either the GSAC, which is the sovereign, AAA, or good quality state paper. So these are liquid papers, but like what you asked, what is the view on the duration? Like I said, we intend to stay in the moderate duration zone. But yes, if the fund managers think so that there's going to be a maybe 25, 50 or 100 basis point action, maybe he will take the duration call for that time being, but over a period of time come back to the moderate duration. But maybe a range of 2 to 5% macro duration is what we will intend to remain max and min.
And if you even have some questions after this, we'll definitely, you can send me the questions and we can try to get that answered by the fund manager.
Sure.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.